Morgan Stanley is predicting a worse financial crisis than 2008. In a recent report, they stated that commercial real estate can plunge as much as 40%. A major real estate developer, Brookfield, recently defaulted on one of their office buildings in LA, and they decided to default on their loans instead of refinancing their property because of higher interest rates and lack of a demand in the office real estate arena. As I stated in other videos, big banks like Bank of America and Chase is seeing this looming crisis happening in the real estate arena. All of these major office buildings that were once occupied with workers working for their employer, and since 2020, with the shift of work from home work, a lot of these office buildings are not as occupied as they used to be. And so a lot of these real estate developers are not receiving as much rent as they used to. And a lot of these loans are becoming due in the next few years for a lot of these major banks. And yes, they can refinance their loans, but they got their loans when interest rates were near zero. And now that interest rates for them are over 5%, it's going to create even more tightening for them because number one, they're not getting as much rent. And on top of that, their mortgage payments will be more expensive. The other major thing to consider is that a lot of commercial real estate is owned by smaller banks. And we saw what happened with Silicon Valley Bank, where we saw a threat happen to their bank and a lot of customers got fearful and did a bank run on that bank and essentially just wiped out that bank in a matter of days. Now, you can imagine if you see this threat happening in even smaller banks, how much more bank runs are we going to have because of this commercial real estate threat that we have? In today's video, we're going to go over Morgan Stanley's recent report and talk about how they see this financial crisis being worse than what happened in 2008. Hey, be sure you all like this video and subscribe down below for some more content around the housing market, personal finance, and the economy as a whole. All right, so just highlighting what happened to Brookfield, they chose to default on their loans on 2 buildings rather than refinance the debt due to weak demand for office space. And so you see this trend happening that more and more people are working from home instead of going to the office as they used to do, because employers are actually seeing that, hey, you can get probably just as much work done working from home as opposed to working in the office, and that a lot of these tech companies are trying to lower their costs. Yes, they are laying off workers, but on top of that, they may not want to invest so much money in a lease, right? In buying or paying monthly rent to an office building where half of their workers are not even working at. All right, so another thing I want to state from this article is that they were saying that with small and medium banks accounting for 80% of commercial real estate lending, the situation might soon get worse. And here is where they state about the prices. They say commercial property prices could fall as much as 40%, rivaling the decline during the 2008 financial crisis. And so what makes this even more alarming is that when you have small and medium-sized banks holding all of this assets, right? All of these assets in commercial real estate, they are more fragile, right? They're not like a Bank of America, a Chase, a Citigroup, where they have their eggs in so many different baskets. A lot of these small and mid-sized banks, a lot of their assets is just tied to real estate or just tied to bonds. They're not as diversified as these larger banks. And so if their pillar of what they stand on falls, like commercial real estate, then that affects all of their other services. And people start reading articles, people start reading the news, and they say, oh, this regional bank, oh, wow, they have this commercial real estate threat. Let me take my money out of this and put it in a larger bank that I know is not going to fall in like a week or two, like what happened with Silicon Valley Bank. All right, now going back to this article, let's be specific about commercial real estate. So here they're saying that if you go to our data centers or in our industrial buildings that are powering e-commerce, they are doing quite well. If you go into the multifamily business, rents may be softening a little bit, but there's still an undersupply of housing. The elephant in the room is office space. That's going through a transformative shift. So here they are stating that yes, industrial buildings, like for different supplies, for products, for things you buy online, for maybe materials for making houses, those are doing well, right? And multifamilies where people actually need to live. But the commercial real estate realm of office space, that's what's truly declining, right? That is what's truly declining. And a lot of people are seeing that threat happening. And so yes, commercial real estate does cover like residential real estate in a way and industrial real estate estate, but it also covers like those skyscrapers you see downtown or these office buildings, and that's a huge threat. And so if that part falls, hopefully these other parts of commercial real estate stand strong and won't be heavily affected by office real estate going down. All right, so another interesting thing about this article that I wanted to highlight was a perspective from a real estate firm. So this is a firm that they buy different properties, commercial real estate to be specific, and they develop multifamily dwellings, beachfront resorts, large residential communities, extended stay hotels, and more. So they're definitely more on the residential side than office building. But even seeing on this side of commercial real estate, they're seeing a decline. Here, they said that the company exceeded $1.5 billion in deal volume, up from 1.3 in 2021. But in 2023, they think these numbers will likely be cut in half because of higher interest rates and just contraction in the number of deals financial institutions will look to fund. So, and this person borrows from regional banks saying underwriting requirements have become stringent. So here, this real estate developer who is invested in the commercial real estate side, specifically in residential like resorts, hotels, multifamilies, even them in this side of commercial real estate is seeing a decline in deal flow. So they're not doing as much because of more strict regulations and requirements from the banks in order to lend these properties. And also it's just more expensive for them, right? Interest rates are higher. And so you have this twofold even happening on this side of commercial real estate. All right, so in this other article, I just wanted to state that here it says that more than 50% of the $2.9 trillion in commercial mortgages will need to be renegotiated in the next 24 months when lending rates are likely to be up by 350 to 450 basis points. Regional banks, given small and medium-sized banks, hold 80% of U.S. commercial real estate debt outstanding. And we saw from the example of the real estate developer that he usually works with regional banks and he has billions of dollars of assets under management, and he goes to a regional bank as opposed to a large bank. And so these regional banks have a lot of pressure. They have a lot of looming threats happening, coming their way. And so they really have to stand first. So we'll just see what happens. But Morgan Stanley is predicting, hey, prices are going to drop in this space 40%, right? This is going to be a worse financial crisis than in '08. All right, one last thing that I want to show from Morgan Stanley publication is this chart just showing the differences between what happened in 2008, 2007, and compare that to what's happening in 2022. So this chart, a lot of things are going on right here. So right here, this side of the chart is just showing all property price. So prices happening in the market. So like if it's a 30% increase, if there's a 20% drop in prices, this is what that is represented by. And then right here, you have office vacancy rates. And so if vacancy rates are up, then that's good. If it's down, that's what Morgan Stanley is talking about. And then like these color lines, the darker line is for major markets for, so maybe LA, Miami, New York, Dallas, Chicago, areas like that. And in non-major markets, maybe it's just smaller markets around the country. And so it's interesting that if you look at office vacancy space, it actually went down in 2007 by a good amount, right? It went back up, it goes back down, back dipped in, pandemic. And then, but right here, showing these lines of the major markets, what's happening across, I guess, the range with vacancy and prices. And so the major market is just showing the price decline happening. And so the price went up year over year by this amount, and then it goes down year over year. And so the year over year rate is definitely going down in price in regards to commercial real estate. All right, let me know your thoughts down below. Do you think that this may potentially be worse than what happened in 2007, 2008 with the whole debacle of real estate? Now, I know the rules of commercial real estate and just getting a loan is different now than what it was back then. People were way more loose back then than what they are now. And so hopefully a lot of these lenders and a lot of these clients that hold these loans were actually in a good financial standing to be able to hold the loan and to refinance the loan. So we'll just see what happens. I'll keep you all updated. Make sure you like, comment down below, and subscribe.